Good afternoon and welcome to the Rural Research Symposium Rural Areas Spotlight Session. All lines are in listen-only mode. This session is being recorded and will be available to watch on demand after we have concluded. If you have any questions, please use the Q&A icon at the bottom of your screen and your question will be answered by the speaker or a subject matter expert. You will also find links to the speakers' bios and the presentation deck there as well. Lastly, if you have any technical issues, please use the Q&A box and someone will assist you. With that, I will turn it over to our first speaker, Jaya, Principal Economist and Director at Freddie Mac. Jaya, the floor is yours.
Hello, everyone. Thank you all for attending the Rural Research Symposium. I welcome you to another exciting panel of the symposium. I'm Jaya, Principal Economist and Research Director at Freddie Mac Single Family Mission and Community Engagement Division, and I will be moderating this panel. Our panel is called Rural Area Spotlight, where we are going to take deeper dive in rural economies and housing markets from the lens of specific geographies. We have two very interesting presentations in this session. Let me introduce you to our panelists. Our first set of panelists are from Ball State University, who will be providing key insights from their recently published research report, The State of Rural Economy in Indiana. We are delighted to host our keynote speaker from last year, Dr. Emily Wornell, Assistant Director of Center for Local State and State Policy and an Assistant Professor of Research at Ball State University. A rural sociologist and demographer, Dr. Wornell's area of specialization are inequality and population changes in rural communities. Joining her will be Dr. Dagney Faulk, who is the Director of Research in the Center of Business and Economic Research at Ball State University. Her research focuses on regional economic development issues, government structure, and state and local tax policy. Joining them, our third speaker in this set of panelists will be Michael Hicks, who is the George and Francis Ball Distinguished Professor of Economics and Director of the Center for Business and Economic Research at Ball State University. His research has been reported in many places, such as Atlantic, Wall Street Journal, New York Times, The Washington Post, etc. Our second set of panelists include Emily Burleson and Katy Stigers, who are going to present case studies from Appalachia and Colonia areas. Emily Burleson is the Research and Advocacy Project Manager at Partners for Rural Transformation. Emily is charged with managing two working groups, the Advocacy Policy Working Group and the Research Working Group. Before PRT, Emily was a disaster resilience coordinator with Fahe, working with families and individuals who were impacted by natural disaster events. Joining Emily will be Katy Stigers, who is the Vice President of Research at Fahe, where her work comprises impact measurement and evaluation, internal research, and case study development for Fahe's members and liaising with research partners. Before we begin the session, I have a quick reminder for the audience. Please click on the Q&A icon to submit your questions during the presentation. With that, I would request Dr. Emily Wornell to take it away.
Thank you, Jaya. And I am delighted to be here with you all again this year. Today, Dagney, Mike, and I will be talking about some of the results from a study that we just published about the state of rural in Indiana. I'll give a short introduction to the report, which will be followed by a quick overview of some of our results from Dagney and Mike. This report was commissioned by the Indiana State Office of Rural Affairs, or OCRA in Indiana, to provide a broad overview of changes in rural areas and comparison to urban areas, with the intention that our results would be used to inform public policy going forward in the state. And because of that, it covers a very broad array of issues facing rural communities and people. The report was released in September of this year, and our Lieutenant Governor has been traveling throughout the state to talk about the implications of our findings. As we all know, there are numerous ways to define rural and what rural is, and we actually have an entire chapter in this report about those definitions and how they're changing over time. But for this particular report, we mostly used a county level non-metropolitan definition, and those are the gray counties that you can see on the map right now. About half, or a little over half, of the counties in Indiana are non-metropolitan, so 48 of the 92 counties, and less than 1.5% of the entire population in Indiana lives further than 30 miles away from a metropolitan county. So it is a pretty concentrated. There's a lot of back and forth between met and non-met in Indiana. We don't have time to go through all of our research, so we're focusing on just a couple of the topics that we thought would be particularly interesting to this audience, namely issues around housing stock and quality of life. And then it's impossible in this day and age to not talk about the implications of COVID, so we will finish with talking about Indiana in a post-COVID world. And Dagney Faulk will start us off with our housing results.
Thank you, Emily. First, we take a look at basic housing statistics in rural and urban areas within Indiana. And a few takeaways from this table are that rural areas tend to have a much older housing stock. About a quarter of the housing stock was built before World War II, compared to about 15% in urban areas. Rural areas also have a lower share of rental housing. About 25% of the housing stock is rental, compared to about 32% in urban areas. And rental affordability is a bit less of a problem in rural areas compared to urban areas. About 31% of renters pay 35% or more of their income in rent, compared to 39% in urban areas. There have been a lot of questions in the media and among policymakers about why there hasn't been more housing built in the state since the Great Recession, particularly speculative housing. We define speculative housing as new homes that are constructed by a builder before a buyer is found. And to look at this issue and examine the profitability of speculative home construction, we use publicly available data to compare the costs of building a home with the average price that a builder would receive in urban and rural areas in the state. And here we've listed the indices that we use from the Federal Housing Finance Agency. We use their housing price index for counties as our average home price. And then from the BLS, we use the producer price index for residential construction. We also include a 17% builder profit. We got that number from the literature of papers done by Glacier and Giorco. And then finally, we also overlay in the graph that I'm going to show you next, the building permits. So these graphs summarize the results of this analysis, showing or comparing the costs of building a house with the price that a builder could expect to receive. And what you see is that before 2010, the average home price, which is the brown line, is higher than the cost of construction in both urban and rural areas. This shows that it's profitable to build housing. And you notice a change from 2010, at the end of the Great Recession and beyond. So from about 2010 to 2016, construction costs, the red line, are higher than average home prices. So in this case, it's not profitable to build new homes, and speculative construction is unlikely to occur. And then further along, around 2018 in urban counties and 2019 in rural counties, we see that it flipped again, where the average price became higher than the cost of construction and speculative building became profitable. So when we're asked why wasn't more housing built, It has to do with the profitability of building new housing, and suggests that the market is working. And then we only have data through 2020, and the pandemic hit. So the real estate markets have obviously changed since then, and continue to. In the report, we also give more detailed analysis at the county level. So if you'd like to have a look at that, it is in the report. Next, I turn it over to Mike to talk about the relationship between quality of life and growth.
Thank you, Dagney. So what you've heard already is this focus of our study and the, I think, rather interesting discussion of housing markets. But that also begs the question, where are people going to move? And so here we have a national study that measures quality of life at the county level. So the way this is from a study from it's Weinstein, Wornell, and Hicks in 2022. And what this study does is measure quality of life the way economists have been doing so for about 4 decades. We just are able to extend it to the county level. We do it 2 ways. Begin by saying we have no earthly idea what individual amenities are preferred, what our individual desire for those amenities might be, but we look to markets, as economists do, to give us some information about that. So we have 2 portions of the market. The first one is the willingness to pay a weight or a premium for new housing or for existing housing stock. So we build hedonic models that measure the value of homes, and the unexplained premium of those that are, we go back one day, that are higher would give us a premium that households would be willing to pay to live there. That's a measure of that quality or willingness to pay for homes. The reverse is true in labor markets. If I'm working and I wish to live in a place, I would be willing to accept a somewhat more modest pay than I would otherwise get for a place I didn't want to live. Then I would be willing to accept a higher pay for that. So in the common literature, you think about this for the housing markets as location, location, location matters. That's what we're measuring. On the labor markets, we're measuring this phenomenon of households' willingness to accept at the margin, given their credentials and skills, a lower wage. The example that we used when this was studied, we published this in a Brookings study, which is that Traverse City, that dark blue dot there in Michigan. The comments there is that it's a half the pay for a view of the bay. So that we combine these together to give a quality of life measure in each county. But we don't know what amenities predict those quality of life. So the next slide shows our use of a regression model called a least angle regression, which tells us what amenities from an exhaustive list of 500 to 600 amenities are most correlated with high quality of life. And we put each of those into 3 buckets: natural amenities, public amenities, and private, or often in the literature referred to as an endogenous amenities. So these make a lot of sense, right? Natural amenities, warmer Januaries, cooler Julys, and more hilliness makes sense. We also find that broad forest coverage and large areas of federal land tend to be lower amenity places. This is not surprising. We haven't, in the study, we show the coefficients here. These are relatively small effects, suggesting that most Americans have already migrated to the places they would like to live on their natural amenity scale. On the public amenities side, the biggie here is school spending as a share of GDP. The effect of this in log terms is bigger than all of the remaining statistically significant amenities combined. A low violent crime rate also matters. Low measured physically unhealthy days or a healthy environment as measured by the CDC's Burfus data. This probably is capturing some environmental characteristics, but could also be capturing the presence of parks or recreational activities. People like to live closer to metro areas, and there's a bias for places where a large number of people work from home. And then on the private amenity side, and again, this is not causal. These could be following people or attracting people. We found that restaurants matter, food and beverage places matter, arts and culture matter, recreation matters. And here we have We have worship places that are negative that shows the sort of risk in this. Follow-up study that we've just in the process of doing is identified this is a statistical artifact, just places that are in decline. It generally had a lot more churches built in them in the pre-automobile days. Next slide, please. So once we've identified the places by high quality of life, and we've identified what amenities predict that high quality of life, we'd like to see whether or not quality of life is explaining population and employment growth. We look here at the 48 counties. We look at quality of life as measured in data from the 2010 census. And then we look at population growth from 2009 to 2019. So we're picking up just the end of the Great Recession to 2019. Then we do the same thing for employment growth. And I'll just draw your attention to the coefficient there. It's a 0.009 in log terms. Those are growth rates. If you moved from being a median quality of life to one standard deviation, which is about 1.25 percentage points on that horizontal scale, that would explain about half the population growth in the average county in rural Indiana. But the size of the effect is about 3 times larger for employment. So we're seeing a lot larger, a more robust effect of quality of life on employment growth, which suggests that the people are moving are young families with a higher employment to population ratio. Next slide, please. We also care about explaining the role of tax rates and population growth. And the reason for this is the taxes generally pay for the most important amenities that we just talked about that predict high quality of life. And so we notice an obvious policy tension that exists, that many places want to be a low cost of living area, so they'll reduce taxes, and we're afraid that also reduces quality of life. So we just show here in Indiana that population growth from 2010 to or 2009 to 2019 is positively correlated with the combined effective state and local tax rates. So residents in rural Indiana are not seeking out low-cost places to live. They're seeking out places that have value because of their amenities. And we think that these combined state and local taxes are really generating that. Next slide, please. The real issue here that we think that these interplay together with are the fact that in the post-COVID environment that we live in, that households are no longer connected. There's a decoupling between housing and labor markets. So the role of housing markets is a lot more important to the quality of life decisions of households. That makes rural places at a disadvantage in many places because they're older and have somewhat more variation in housing stock. If we look at Indiana throughout the last decade, and this is true of much of the rural United States, the cost of speculative construction was higher than the average home price, which means speculative construction just really plummeted in this expansion from the Great Recession. So we think that there was a recovery in about 2019. We don't have good post-2021 data yet, but we just note that both the cost of a new home and the price went up. Be interesting to see at the end of COVID how that worked out. Amenity-rich places that have higher quality of life are going to have a higher population and job growth, and this is true in rural areas, in micropolitan areas. Government amenities, in particular, those that are associated with local government, such as school quality, the ability to work from home, which may be broadband, have the highest quality of life correlations. And amenity-rich rural counties are also more likely to benefit from that relocation of remote workers, because these may be places where job markets weren't thick enough to be attractive to many of those residents. So we think that these, in general, suggest that policymakers need to think more effectively about improving amenities rather than the traditional economic development policies such as tax incentive or tax breaks. That's all we have. And we invite you to look at the study here at this link. And with that, I'm going to turn it over to Emily Burleson.
Thank you, Michael. This presentation is a practitioner-focused look at Duty to Serve's implementation in 2 rural regions in America. My name is Emily Burleson from Partners for Rural Transformation, and my co-presenter is Katy Stigers from Fahe. So The question we wanted to answer in this presentation was simply, are we serving both people and places that have been left behind in the opportunities for home ownership? Due to this, our project uses 2 community development financial institutions, or CDFIs, which are members of the Partners for Rural Transformation. We look at our transaction data from recent years to analyze duty to serve's reach in these CDFI areas. We will share some surprises we had when we took a look at the data. And finally, we'll outline some key insights and suggestions for maximizing DTS impact in rural areas. We'll also have time for questions after the presentation concludes. So as we mentioned, this presentation is the work of several team members. I'm Emily Burleson, the Advocacy and Research Project Managers for Partners for Rural Transformation, or PRT. My co-presenter is Katy Stigers, Vice President for Research at Fahe. We also want to thank our colleagues Tamara Longoria and Daniel Elkin at CDCB and Camilla Moreno at Fahe, who were not able to join us as presenters today. Thank you to Freddie Mac for hosting the Rural Research Symposium. We are grateful to have the opportunity to present to you all today and share some of our insights from the front lines of mortgage lending in underserved areas. So our project is practitioner focused, and so it's worthwhile to let you guys know a bit of background of who we are and what we do. The Partners for Rural Transformation, or PRT, is a national coalition made up of 15 organizations who all serve rural communities in persistent poverty areas across the nation. Our steering committee is made up of 6 place-based CDFIs who serve 3/4 of the country's persistent poverty counties. 2 of our partners that are a part of the steering committee are Fahe and Come Dream, Come Build, or CDCB, which are the focus of today's DTS presentation. PRT and PRT partners serve rural persistent poverty counties, which are defined as counties where 20% of or more of the population have lived below the poverty line for at least 3 decades. Over 20 million people in the United States live in these persistently poor communities, and majority of these are rural communities of color. Fahe brings people, organizations, and resources together to build homes, communities, and a thriving Appalachia through expanding economic opportunity and security for all. Fahe serves as the direct link between national transformative resources and local Appalachian leaders. By leveraging relationships with funders, investors, and partners, Fahe connects these local leaders to national resources, empowering them to enact positive change in their communities. Fahe is a network organization of 50-plus nonprofit organizations serving Kentucky, Tennessee, Virginia, West Virginia, Maryland, Alabama, and over 40 years has cultivated deepest reaching platform to connect investment to boots on the ground leadership throughout one of the most difficult places to serve in the country. CDCB, Come Dream, Come Build, is another PRT nonprofit partner that is headquartered in Brownsville, Texas. CDCB was founded in 1974 and is governed by a community-based board consisting of 12 volunteers. CDCB serves the southernmost area of the United States, including counties that share a border with Mexico and the Gulf of Mexico. CDCB is a multifaceted affordable housing organization devoted to utilizing collaborative partnerships to create sustainable communities across the Rio Grande Valley through quality education, model financing, efficient home design, and superior construction. We are indebted to our colleagues at CDCB and Fahe for providing data, analysis, and interviews to support our presentation today. So now we're also going to give some background for duty to serve. As many of you probably know, back in 2016, the Federal Housing Financial Agency, or FHFA, released a final rule that resulted in the implementation of DTS. This was mandated by the Housing and Economic Recovery Act of 2008. This required that the government-sponsored enterprises, or GSEs, Fannie Mae and Freddie Mac, serve 3 specified underserved markets: manufactured housing, affordable housing preservation, and rural housing by increasing the liquidity of mortgage financing for very low, and moderate income families. The GSEs had to submit a 3-year proposal strategy for serving these markets, outlining their objectives and activities. The FHFA rejected the first set of plans presented in early 2022, and the FHFA is charged with the review of the new enterprise's performance of these new presented plans. The geographies DTS aims to focus on are rural areas and high needs rural areas, such as Middle Appalachia, Colonias, the Lower Mississippi Delta, persistent poverty counties, and a census tract that is located in a persistent poverty county and is not included in Middle Appalachia, Lower Mississippi Delta, or Colonia. This map shows the overlap of Fahe and CDCB service areas and persistent poverty counties. You can see the persistent poverty counties outlined in red and the clustering of persistent poverty counties in majority rural areas, including the Appalachian region, which is Fahe's service area, and the Texas Colonias along the US-Mexico border, which is CDCB's service area. In DTS's eligibility guidelines, it states that it classifies Middle Appalachia, the Lower Mississippi Delta, a colonia, a tract located in a persistent poverty county, not included in those areas, are part of their service area and targets. Fahe, CDCB's, and PRT service areas have a really big overlap with DTS. The geographic reach illustrated in the map underscores why Fahe and CDCB were great organizations to use to analyze DTS loans in their service area. Our main questions starting this process were, how many DTS loans are being made, where, and what type of loans? We looked at how many loans were made between 2017 and 2022 through June. More than 2,000 loans were made, focused within Fahe's service area, the Appalachian region. Those loans were concentrated within the persistent poverty counties. In this map, the blue, orange, and yellow pins indicate the GSE's DTS loans made. These loans are a relatively new area for Fahe. Once we did begin making these loans, we grew quickly. What we know is that when we have the capacity, both financially and in terms of staff, we can move these dollars to people and places who need them the most. It's also interesting to note that if you were to zoom in on this map on the blue Appalachian region, the majority of loans shown on the pins are actually very close to the intended underserved areas, but are actually located in adjacent affluent areas or surrounding metro area. Few are actually within the red outlined persistent poverty counties. So Katy is now going to discuss what we learned when we reviewed the transactions and borrower characteristics. So I'm going to pass it off to Katy.
Thanks, Emily. So if you, when we look at the actual transaction data in CDCB service area, both CDCB and Fahe made quite a lot of loans, but we narrowed down our focus to just GSE loans. And what we learned is that after taking several years to prepare to be qualified to make GSE loans, we were able to generate a total in the CDBC Colonias area, 6 Freddie Mac conventional loans. And the average amount of these loans was right around $70,000. The average income for the borrowers of those loans was around $26,000. But we were surprised, and the loan staff we interviewed were also surprised to see that the borrowers were typically very qualified. So while we're making these loans in DTS places, the people served were pretty highly qualified buyers. They are right around in the moderate income range of 80 to 100% of area family median income. And then compared to the first year in 2019, the amount of loans didn't see too much change, but the average amount per loan, but there was a change, in the area average area median income. And by 2021, the average area median income nearly doubled. So the credit scores also remained nearly identical, but with a slight dip. What we wanted to understand is why there were not as many DTS loans that CDBC might be making in the Colonia's persistent poverty regions. And so we asked a loan officer so we could get a practitioner's perspective on this. We also were curious about how the average credit score compared than what we expected, assuming that it would be lower given the relatively lower incomes and opportunity for finance in these DTS areas. During this conversation, we learned several things. First, it took over a year to get fully up and running as a GSE seller servicer because of compliance requirements and training. Shortages of staffing for all parts of the loan also played a role. Interest rates played a big role in which products borrowers chose. The CDBC staff stated, it's the pricing that makes the difference. As home prices have gone up, interest rates mattered even more. And this makes sense. If you're trying to get a loan for a home mortgage, you're going to choose the product that makes the most financial sense in the long run. CDCB focuses on empowerment and empowering the agency of the borrowers. So they give out information on all products and let the clients decide the best option for them. Income is the biggest eligibility obstacle. If you don't make enough income or have a high enough credit score, a client can't get a conventional loan. Another important obstacle, which our interviews revealed, was that a lot of people are applying for these GSE conventional loans, but the majority of the folks who qualify don't have the down payment funds saved up to cover down payment or closing costs. These are a barrier to otherwise qualified home buyers. Many customers instead choose to go with loans that are able to include grants that assist with closing costs. That assistance is a make or break piece of their housing puzzle. And it's the difference for many between staying in substandard housing and a client getting into a affordable new home that they own. Another artifact of the CDBC data is that areas that used to be considered rural have been redefined into metropolitan areas because of growth nearby. So while they may still be rural themselves, the adjacent area is not rural and they've dropped out of the duties served classification. This reduces some of their access to other resources that might be available based on their place-based characteristics and reduces access to funds that their clients might use to purchase homes. In order to serve their community, CDCB has used its capital to create products designed particularly for these people. Only one DTS loan was made in a rural area for CDBC between 2019 and 21. But if areas around Brownsville had not been reclassified as non-rural, we might see more DTS eligible lending. Another important factor, according to the loan officer we interviewed, is that the lack of down payment and closing cost assistance is a huge factor in the low number of rural loans in this area. Being able to deliver GSE mortgages is an overall positive opportunity for the organization because it allows them to serve clients who maybe earn too much or are purchasing more expensive homes than other products with more subsidy would allow. So they're able to reach a new market segment within their own community. And while the geographic designations mean that CDCB isn't necessarily making as many DTS loans as they would like, they are still serving a poor and important colonious area. We also see this with Fahe. Having flexible products or flexible capital on our balance sheet can enable community organizations to meet borrowers on terms that make sense for their economic situations. So the other data that we looked at was from Fahe. And between 2018 and 2022, Fahe made over 2,800 loans, but only 64 were GSE. Part of that relates to when Fahe became qualified to offer GSE loans, but we looked deeper to see if there were other trends we could understand too. We were surprised to see that the average area median family income was 130% and that the average loan amount was nearly $137,000. The average credit score was over 750. In 2021, the number of loans Fahe made and the average loan amount jumped. Fahe had over 30 GSE loans, and the average loan amount increased a little over $30,000. The AMI increased 2 percentage points, while the average credit score remained about the same. Once again, these are very qualified buyers, and they may be living in a poor or adjacent to a poor or persistently poor area. They themselves may not even have an especially high income, but compared to their neighbors who have very, very low incomes, that puts them outside of what would be considered a low or moderate income for their locality. We also interviewed Fahe's loan staff to understand more about their perspectives on what this data showed. Fahe's process is similar to CDCB's in that each client receives the opportunity to choose the product that makes the best sense for them, given their wants, needs, and eligibility criteria. Fahe typically looks at USDA loans for their clients first if they are in a rural area because they tend to be the best financial option for many of these clients. Staff told us Fahe needs more product options that don't require clients to pay private mortgage insurance, since that can be upwards of $200 a month, as prospective borrowers are very sensitive to each dollar on their house payment, including principal, interest, and escrow. Fahe can often help make the overall cost lower if they are able to offer 2 mortgages to these clients, where the GSE product is the first mortgage and other costs are covered with a second mortgage. But clients sometimes balk at the idea of a 2 mortgage situation. Even if the overall cost is better, clients prefer just a single mortgage on the property. For many of the lower income or lower credit score borrowers who are in rural places, this USDA product then is a better fit. But similar to CDCB, the GSE products allow Fahe to serve a different market niche for those who don't qualify for programs for lower income borrowers. And as we see with the possibility of first and second mortgages, the need for down payment and closing costs are a real barrier to many borrowers. At Fahe as well, loan officers were surprised at the average credit score. They were also surprised that when we shared that on the DTS single family dashboard from 2021, the average credit score for borrowers was between 746 and 759, similar to the Fahe reported credit scores. The DTS national dashboard also showed that in 2021, 8% of loans were made in high needs rural area and had an average score around 680, which is less than the national average credit score. And this led us to ask if DTS is hitting the lower income borrowers and those who are more in need of affordable housing. Fahe's interviewees looked at this dashboard and shared that many lenders may have overlay rules where, for example, a loan product requires at least a 640 credit score from the borrower, but the company looks at their overlay for underwriting and actually won't accept a credit score under 700. The gap between what's allowed and what the company preferred may mean that there's a lost opportunity to serve folks in higher need areas or who appear higher risk. This is where the CDFI world really makes a difference. CDFIs are not necessarily restricting themselves in this way. While a GSE product may not be a client's first choice due to other products that are better able to meet their financial needs, the community-based lenders also may not have additional restrictions for whom they will lend and can work with those borrowers to prepare them for these loans. So while some GSE loans are better for people who have higher income requirements or might not be in a USDA rural area, other borrowers simply just want to avoid having 2 mortgage payments. They also don't want to have private mortgage insurance. Fahe staff felt like borrower education could help lower some of the discomfort for clients with this situation. And they also felt, though, that it would be better coming from a housing counselor rather than with a loan officer, so that they had that information before they go in to make their determination on what loan products they'll choose. This is because the loan officers don't want to see that they're pushing a particular product toward a client. They have a high level of trust with the folks they're working with, and they don't want to seem like they're showing a preference for one kind of loan over another. But the result is sometimes that a borrower might choose a higher cost loan overall, or they might go to a different lender and seek out a loan where they can get down payment or closing cost assistance. The length of homebuyer education is another deterrent or challenge. Classes can be as many as 8 hours long, and it makes the clients feel as they're being pushed off to someone else. And so that, along with barriers like childcare or work conflicts, makes it difficult for them to complete the buyer education. So it's for their benefit as a consumer, but they may miss out on the opportunity to build rapport with their loan officer by having a single point of contact. Finally, there's a lot of competition, or there has been, and this may change with recent increases in loan interest rates, but they take a lot of time at Fahe and CDCB to build rapport with their clients and work them through the different options. Many of their clients aren't aware of the different options available to them. While for-profit organizations might be less likely to take this time, they can sometimes go through the process more quickly. The loan officers at both CDBC and Fahe felt that time was an important component, but also results sometimes in people missing out on a more affordable loan. Online mortgage companies are a huge source of competition. Our loan officers also shared that folks with more higher credit scores who are more qualified borrowers may tend to go to an online mortgage company because they have the option and privilege to refinance or get a loan online quickly. So they have less time to sit in an office, they don't have to do homebuyer education, and it's more efficient. However, Fahe particularly noted that our borrowers tend to prefer to talk through options in person, face to face, and that just takes longer, and it takes longer to move that product. But it's a really important component of our mission to make sure that we're serving folks in the way that they need. Finally, Fahe loan officers noted that the online market seems to be where younger buyers and younger millennials or Gen Z home buyers are going to do business, and that may also be a challenge. So as we noted, the GSE products are not quite getting, based on the map, maybe where they exactly need to be. The translation of plans to serve these markets aren't necessarily hitting rural areas in terms of serving lower income borrowers, at least according to our data, but they are serving people with higher incomes in persistently poor places. And so we need loan products that will meet these harder to serve populations' needs. And once capital is there, we are able to make the loans, as our overall data show. More than 2,000, almost 3,000 loans made during this period with other more flexible products. DTS loans, as we saw, were going to higher income borrowers. This surprised the loan staff, but they noticed that there are some real particularities in terms of what makes a good match with a lower income borrower in a rural place, and made some suggestions for the flexibility that could allow us to serve more people with duty to serve products. An article that was recently published by the Lincoln Land Institute acknowledges that there have been improvements from GSE in terms of the DTS goals and objectives set forth, but noted the Underserved Mortgage Markets Coalition, 21 leading national affordable housing groups, encourage more. They released a scorecard for the 2022 to 2024 approved DTS plans and want to evaluate whether the goals are being met. They've also released recommendations to help the GSEs have a higher impact in their target markets and geographies. Based on our interviews with staff, there's a lot of opportunity to increase these, access to loans for homeowners through these DTS plans. Particularly organizations that have smaller staff might need support or flexibility to develop the capacity to work with GSE products. And Fahe in particular noted that the staff member that they were partnered with was an invaluable help in getting Fahe ready to make DTS loans through the GSEs. Another thing to think about is how definitional changes related to rurality affect, create patterns in the data that may look like we're not serving rural areas when in fact, for the people who live there, they definitely are. Fahe and our partners have the capacity to move dollars to high need areas, but would require additional funding like EQ2 to get more flexibility to make the GSE loans to solve the problem of things like closing costs and down payment assistance. There are potential home buyers qualifying, but they're choosing other products. So if we had additional access to capital and flexibility with those dollars, we could improve the utilization of GSE loans to meet our duty to serve goals. Thanks so much for the time and taking an interest in this project. And we hope you'll contact us to learn more about how Partners for Rural Transformation are working in this region and helping increase the impact of GSEs. And I'm going to hand it over to Jaya now. Thank you.
Thank you, Katy. And I thank all the presenters for their amazing presentations. I think there was a lot of valuable information from both the presentations. Let me see if I can summarize the key takeaways from each presentation. I'll start with Ball State researchers. They shared some key tidbits from their report, The State of Rural Economy in Indiana. And I think they made four key points, actually. First, the housing stock in rural Indiana is typically older, with higher vacancy rates, higher owner occupancy, and relatively higher affordability. Number two, before the Great Recession, the cost of construction was lower than house prices. After the recession, that flipped, until 2019, making speculative housing less profitable. The rural communities' actual demand for housing is so low relative to the supply due to population decline that building new homes is not profitable. While they don't have the most recent data capturing post-pandemic trends, they made some key observations and hypotheses for recent trends. While price increases during the pandemic has served as an incentive to construct more housing, supply side issues such as labor shortage in the construction industry and higher prices for construction materials are likely to stifle development in many parts of the state. Number 3, there is positive relationship between population growth and quality of life, as well as between employment growth and quality of life. Improvements to quality of life attract people and jobs in these effects in rural counties, not just in urban counties. And lastly, they conclude these results suggest that the policymakers should focus on improving amenities in addition to the more traditional economic development policies such as tax breaks. Now I'll move on to the next presentation by PRT. First of all, thank you very much for sharing this valuable information. We appreciate you sharing these resourceful data points with us. While we may not have all the solutions that you need to serve these communities, these insights will help us to hone in solutions tailored to specific needs of these duty to serve markets. We recognize the importance of CDFIs in these key underserved markets as they have that communication and direct access with the consumers and loan officers. I want to mention that our duty to serve team, headed by Simone Beatty, is working towards leveraging their expertise in developing solutions to give them the pathway to liquidity that they need to be successful in these markets. Now, coming to the presentation, as a researcher, I feel like I learned a lot from the loan profile and the 2 case studies that you presented. I have 2 suggestions that can be worthwhile while you explore some extensions. Number 1, you noted that on average, the GSE loans were typically made to more qualified borrowers, that is, with higher income and higher credit scores. And the trend was going upwards from 2019 to 2021. I think it could be helpful to see the breakout by purchase and refi loans separately to better understand the extent to which this upward trend was driven by house price appreciation versus the refi boom that we experienced in 2020 and 2021. My second suggestion is around the 2 case studies. It's interesting to hear the loan officers had an opportunity to reflect upon the data that you presented. It is very helpful to hear their perception and reaction to the profile that you are observing. Expanding these 2 case studies to more comprehensive data set could be worthwhile, as it could provide a more holistic view on the barriers and opportunities around these communities. All right, we are now ready to take questions from the audience. Our first question looks like can be either for Dagney or Michael. Can you comment on the trends in building permits? How does that tie into the demand for speculative housing? Was there any urban-rural difference in the trends?
Thank you for that question, Jay. I didn't really talk about building permits during the presentation, but first is, as you can see from the slide, there is a difference in the magnitude of building permits in urban and rural areas, and that there are many more in urban areas than in rural areas. The second point I'd want to make is that this is the average number of building permits over all rural counties and then all urban counties. So there are some counties where housing was profitable over the entire period, like some of the counties north of Indianapolis, so that there was speculative building going on in those counties over pretty much this whole time period. Again, because these graphs are based on averages.
I think that makes sense. The fact that the building permits are trending upwards, not just in the urban, but also in the rural markets, I guess is a positive thing, as it means that there is more buildable capacity to absorb the demand as it rises in the post-COVID era. Let's see. Our next question is for Ball State. I think this is probably for Michael. This question is actually very timely, and I'm very curious to know the answer as well. How has COVID impacted the relationship between quality of life and migration?
Yeah, Jaya, thank you. That's a great question. So, in the pre-COVID period, we actually saw low single-digit levels of work from homes, depending on how it was measured, maybe 6 or 7%, in many places 2 or 3% in rural areas. So it wasn't a big portion of the market. If we look at the Bureau of Labor Statistics household pulse surveys that are most recently about 8 weeks old, we see about 48% of Americans college graduates working from home at least 1 or 2 days a week, and about 20% working a full week from home. As it goes down to high school graduates, or overall in the market, it's about 24%. For high school graduates, about 18%. So work from home just exploded in the post-COVID world, and we'd expect to continue to explode. And so for rural places, that there's two issues here. One is, do you have the quality of life, that housing component, and the amenities that would make it attractive for residents to move there? And if you look at the things that matter most to residents in those areas are predicting high quality of life and housing markets, again, it's the same things that we come up with: low crime, good schools, some of the infrastructure to work from home are really going to matter. The other thing that matters is that a substantial share of those households are still, as they work remotely, are still accessing urban labor markets, or they have to get to an airport. So being a compact state, as Emily mentioned at the beginning of our talk, makes some states like Indiana more advantageous for many of its rural counties. There are very few places in Indiana where you can't get to an international airport in an hour or an hour and a half, and that's really very convenient for many folks, and it also allows a broader set of labor market opportunities for households who might have to go to work 1 or 2 days a week. And so, I think for Indiana's market, and generally for the nation as a whole, this is a once in a hopefully a couple hundred year type event for attracting or moving some share of households from urban places to rural places. And if you don't have the assets that you need today, there's still time, because I think that we're going to see a steady increase in the share of remote work as we get better at it, as younger workers become more accustomed to it, and as the composition of labor moves away from the on-site work that dominated sort of earlier industries to more and more occupations that are remote work capacity.
Thanks for your response. I definitely agree with you. I think these amenities, including high quality internet services, those could play a key role. And for some of the increased demand for remote work, along with desire for bigger living space, will drive some of these trends. So I would be looking forward to some of the stats that you showed today, how that changes as you get more updated data.
Thank you, Jaya.
Now let's move on to the next question from the audience. This question is for Emily and Katy. Your case study lay good foundation on the borrower profile and loan officers' perception in these key duty to serve markets. What specific research topics should other researchers dig into to help better understand the challenges faced by these communities?
Thank you, Jaya. That's a great question. And one of the things that we suggest is that we actually look more at the CDFI portfolios in general and think about what they're able to hold on their balance sheet and why they're so successful at that. When we look at portfolios like the ones that CDFIs are able to manage successfully and season over time, they aren't what most people would consider great risk. They might have multiple risk factors represented in those portfolios: low credit, low liquidity, And yet the CDFIs are able to successfully weather challenges like the recent pandemic, like the 2008 housing crisis. And there's something important about the embeddedness in the communities, as you mentioned, that allows them to successfully work with this population. So I would suggest that additional research into what is going well and what makes these CDFI portfolios successful, and potentially how to help others learn how to mitigate risk, other players in the sector learn how to mitigate risk too, could help expand access to finance for many folks who have been left behind.
Thank you, Katy. I think you made really good points. There is definitely opportunity for the research community and the thought leaders to contribute to this literature further. Our next question again is for Katy and Emily. Are there organizations outside the GSEs on innovative model that are working on innovative model that could channelize more liquidity to CDFIs operating in these markets? Are there additional resources that GSEs could leverage?
Thanks. What we find is actually not consistently. Occasionally, a large player, a bank, or a philanthropy, or even a federal agency will make a one-time step into this market. But when we compare the housing market, the homeownership market, with the rental market, we don't see consistent federal or private sector investment in it. And so what would be outstanding is to see the GSEs and maybe other federal agencies come up with a national strategy to impact homeownership in the way that we've seen with some different programs in the rental side. So like low-income tax credit financing and things like that. So we'd like to see the opportunity to lead from the GSEs to see consistent scale funding that allows us to help move this money through hard-to-serve places and make an impact in low-income areas.
I'm sure our Duty to Serve team is taking notes and will explore ways to find out innovative ways to develop solutions. All right. If we don't get to your questions today, we will follow up after the conference for a response. Thank you again to today's speakers. As a reminder, the session recording will be available at the end of the conference. The deck for this session will be posted in the Resource Center. We will now go in a 15-minute break and return at 2:15 for our next session on energy, environment, and sustainability. You can use this time to complete the end of the session survey or go to the game room. Thank you again for joining and have a great day.